$180,000 after 20 years in KiwiSaver. That's what the average Kiwi ends up with. But here's what they don't tell you. If you own the right 3 stocks directly instead of relying only on a managed fund, you could have $230,000 to $280,000 in that same 20 years. Same contribution. Same time frame. Completely different outcome. Welcome to dollar displacement. This is specifically for Kiwis who want real numbers, not theory. Most of you already own these 3 stocks. You use them every day. You buy from them. You pay them. You probably have no idea you're a shareholder. That's the problem we are fixing today. The average Kiwi saves about $200 per month into KiwiSaver. At an average return of 5% per year over 20 years, that becomes $180,000 before tax and after fees. Sounds reasonable. Then inflation hits. Over 20 years at 2.5% average inflation, that $180,000 has the purchasing power of roughly $120,000 in today's money. You've actually gone backwards in real terms. Now here's the shift. The NZX 50 index, which tracks New Zealand's 50 largest companies, has returned an average of 9% per year over the last 10 years. Not all years. Not perfectly. But on average. That's almost double the 5% most balanced KiwiSaver funds deliver. The 3 stocks we are talking about today make up 35% of that index's value. They are the heavyweights. They are the ones institutional investors buy when they want reliable, boring, long-term wealth. And here's the thing. They are also the ones you can buy directly on the NZX for a brokerage fee of just $10 to $15 per trade. The first stock is a utility company that provides infrastructure to almost every Kiwi business and household. The second is a telecommunications and media company that Kiwis interact with multiple times per day. The third is a financial services company that owns everything from banking platforms to insurance products. You're already paying these companies. The question is, are you profiting from them, or are they profiting from you? Let's talk actual numbers. If you bought $5,000 in the first of these 3 stocks 5 years ago, you'd have roughly $8,200 today. That's a 5.8% annual return. Plus, that stock has been paying you dividends the entire time. Average dividend yield on this stock is 4.2% per year. So while your capital grew, you are also getting paid $210 per year in dividends on that initial $5,000 investment. Most people don't see this because they are in a managed fund. The fund collects the dividends, reinvests them or pays them out, takes a fee, and you never actually feel the wealth building. When you own the stock directly, you see every single payment. You feel it. You understand it. And research shows that's why direct stock owners stay invested through downturns. They actually know what they own. Here's the framework. 4 steps. You can do this today. Step 1. Open a brokerage account. This takes 15 minutes. In New Zealand, the main platforms are SmartShares, Sharesies, Hatch, or Interactive Brokers. Pick one. The fees are roughly $10 per trade on SmartShares, $0 to $3 on Hatch depending on the platform you choose. I'm not recommending any of them specifically. Just showing you the cost structure. Step 2. Research the dividend history and P/E ratio of each of the 3 stocks. P/E ratio is price to earnings. Lower than 15 is generally considered reasonable for a utility or telecom. Higher than 25 is a warning sign. You can find this on the NZX website in literally 60 seconds. The dividend history you can check on the company's investor relations page. Any stock paying a dividend of 4% or higher consistently over the last 3 years is a stock worth investigating. Step 3. Open positions. Don't try to time the market. Don't wait for a crash. Just start. Buy your first $1,000 in the stock you feel most confident about. Then in week 2, buy $1,000 in the second stock. Week 4, buy $1,000 in the third. Spread it across a month. This is called dollar cost averaging, and it removes emotion from the decision. Step 4, set it and forget it. You're not trading. You're not checking every day. You're building. Every month for the next 10 years, commit to putting $100 per month into one of these stocks via a recurring buy order. That's $1,200 per year. $12,000 over 10 years. At an average return of 9% per year, plus dividends of 4% reinvested, that becomes $19,000 to $22,000. That's $7,000 to $10,000 pure profit sitting on top of your contribution. Not magic. Just time and compound growth. And that's only if you invest $100 per month. If you go to $200 per month, which is what a lot of people can do by cutting one subscription and one coffee habit, you're looking at $38,000 to $44,000 after 10 years. Let me put that differently. $200 per month for 10 years equals $24,000 out of pocket. You end up with $38,000 to $44,000. The market and dividends just handed you $14,000 to $20,000. Now let's talk timeline. At 30 days, you've opened an account, bought your first stock, and received a confirmation. You're up or down maybe $50 to $200 depending on market movement. This is normal. You're not down money. You're just seeing volatility. Ignore it. At 90 days, you've bought all 3 stocks across 4 weeks. You own roughly $3,000 in positions. The market is up around 1% to 3% for the quarter on average. You've also received your first dividend payment on at least one stock, probably $25 to $60 depending on how much you invested. This is the moment it gets real. You now understand what it means to own a business. At 365 days, you've invested $1,200 to $2,400 depending on whether you went with $100 or $200 per month. The market might be up or down. If it's a good year, you're up $300 to $500 on capital gains plus $80 to $150 in dividends. If it's a down year, you might be flat or down 5% on capital. But here's what matters. You now own 3 businesses. You're getting paid dividends. And you understand that wealth building is boring, consistent, and mathematical. Not flashy. Before tonight, here's the one thing you need to do. Write down your current KiwiSaver balance. Write down your annual contribution. Then calculate, at 5% return, where will you be in 10 years? Use any online calculator. Just know the number. Then ask yourself, what if I added $100 per month to direct stock ownership of the 3 biggest NZ companies? What if that money grew at 9% instead of 5%? Difference is roughly $35,000 to $50,000 in 10 years depending on your starting point. That's not theoretical. That's your money. That's the gap between okay wealth and real wealth. KiwiSaver is your foundation. Don't replace it. But it's not enough. The 3 stocks are the next layer. Start tonight. Open the account. It takes 15 minutes. Go.